Historically, when engineers built a medieval fortress, they didn't just stack up a single wall and call it a day.
Right, no.
They dug a moat, they built an outer perimeter, they reinforced the inner wall, and then finally they secured the central keep.
Yeah.
Because the entire philosophy was that even if the outer perimeter took a massive hit, the core would just remain completely untouched.
Exactly.
And today we are looking at Public Bank Berhad.
Oh, yeah.
Which has long been considered the ultimate, impenetrable fortress of the Malaysian banking sector.
It really has.
But their latest Q2 2026 earnings just showed a visible crack in the outer wall.
A pretty noticeable one, yeah.
Right. And analysts are calling it a soft patch. So our mission today for this deep dive is to find out if the central keep is actually compromised.
Yeah, and it is the defining question for anyone holding this stock right now. Because, you don't design a fortress for a sunny day, right?
Yeah.
You design it for a siege. And what we are seeing in this first half of 2026 is, it's the banking equivalent of a sustained siege on profit margin.
Exactly. Wow. And we need to figure out how they're weathering it. Yeah. For those of you tracking this stock with us, this deep dive is the highly anticipated follow-up to our previous analysis, the one titled Public Bank FY 2025 Earnings Review, 22.5 sen dividend, LPI boost, and growth ceiling.
Right.
We've been analyzing this company's evolution through the Q1 and Q3 of 2025 deep dives, watching that LPI insurance acquisition play out.
Yeah, that was a big theme.
But now the narrative has kind of shifted. So let's look at the raw data for the first half of 2026. What exactly is this crack in the wall?
Well, for the first half of 26, Public Bank's consolidated net profit came in at 3,576.3 million ringgit.
Okay.
And Q2 specifically brought in 1.8 billion ringgit.
Right.
Now, that is technically a year-over-year increase, but
it's small.
Right. It's only up a very flat 2.0%. Yeah, and core net profit actually came in slightly below market expectations. It was sitting at just 47.4% of full-year forecasts.
Wait, 2.0% growth for a banking institution of this size?
I know.
That barely paces inflation. Why are analysts at HLIB Research gently labeling this a soft patch instead of, throwing up a structural red flag?
It's a fair question.
Because if I am an investor looking at trailing 12-month earnings per share, which is idling at 37.5810 right now, I'm asking why the engine is sputtering.
Well, it's because the engine itself isn't broken. The terrain has just gotten incredibly muddy.
Okay, how so?
So the shortfall is primarily driven by lower than expected net interest income. This is a classic net interest margin, or NAM, compression scenario.
Okay. Let's do a quick analogy for the listeners here. NA is basically just the markup a grocery store charges on a carton of milk, right?
Exactly.
When competition gets fierce, you have to lower your milk prices to keep your customers coming in, which obviously squeezes your profit.
That's spot on. But it's vital to understand the mechanism here, because it isn't just about Public Bank being forced to offer cheaper loans to compete.
Right.
It's happening on the funding side.
The cost of their raw material, which is cash.
Yes. In previous deep dives, we discussed how the Malaysian market operates. And we aren't talking about a simple markup on goods here. If competition gets fierce, you have a full-blown fixed deposit rate war.
Right. Which we are seeing right now.
We are. There is intense liquidity competition in the domestic market. Every major bank is throwing promotional fixed deposit rates at retail savers just to keep cash in the vault.
Yeah.
So if Public Bank wants to prevent their depositors from migrating across the street for a better yield, they have to match those higher deposit rates.
Which means they pay more to hold the money.
Exactly. But you can't necessarily charge your borrowers more to lend it out, so the spread compresses.
So they are actively sacrificing their margin to defend their market share.
Yeah, essentially.
But if they are paying a premium to depositors and NIM is shrinking, doesn't that inherently drag down their return on equity?
It does.
Because I'm looking at our notes from the Q1 and Q3 2025 deep dives, and historically, their ROE was hitting 13.2%.
Yep.
I think even pushing 14.8% years ago.
It was, yeah, in the golden era.
Right. And right now, it's at roughly 12.0%. So if I'm a long-term shareholder, isn't a multi-year structural decline in ROE a massive red flag? Why should anyone celebrate 12%?
Well, you're right to push back on that because, a shrinking return is never the goal.
Right.
But you have to contextualize that 12.0% against the macroeconomic reality. Yes, it has come down from that 14.8% high.
Yeah.
But that 12.0% still actively tops the domestic peer averages.
Oh, really?
Yeah. The reason they haven't slipped down to an 8% or 9% ROE like some of their competitors during this deposit war, it comes down to one specific structural advantage.
Okay. What is?
Their cost-to-income ratio, or their CIR.
Okay. This is where we look at operational efficiency. Let me jump in here. Cost to income is simply how much you spend to make a dollar.
Right.
Public bank spends about 35 cents. They have a 34.9% CIR to make a dollar. While the domestic industry average burns through about 45 cents, a 45.2% average CIR to make that same dollar.
Yeah, it's a huge gap.
It is. That 10-cent difference is their ultimate operational moat.
But, I mean, let's dig into the how. It's not just about, skipping avocado toast in the corporate boardroom or turning the air conditioning down.
No.
How do they maintain a 10-cent operational advantage over equally massive competitors?
It is decades of relentless optimization. Their legacy physical branch network is fully amortized, and their staff productivity per branch is just ruthlessly efficient.
Okay.
They don't bloat their middle management, and they have historically integrated their back-end IT systems without the massive disjointed overhaul costs that other banks face after, messy mergers.
Right. So that 10-cent difference is their ultimate operational moat. When your margins compress, like they're doing right now, having the absolute lowest overhead in the industry protects your baseline cash flow. You can afford to take a hit on income without plunging into the red.
Okay, but if they're sacrificing interest margins to keep customers, the logical assumption is that they might be tempted to take on riskier borrowers to make up the difference, right?
You would think so, yeah.
So let's look at their asset quality to see if they're lowering their standards to chase yield. What does the gross impaired loans ratio, the GIL, look like in Q2?
Well, it stands at a pristine 0.54%.
Wow, 0.54% against a domestic industry average of 1.43%.
Exactly.
That is incredibly low.
Okay.
I mean, GIL is basically the percentage of your friends who borrow money and ghost you, right?
Yeah, that's a good way to put it.
Public bank is incredibly picky about who it lends to, so almost none of their friends default. It's like their underwriting process is less like a bouncer at a nightclub just glancing at your ID, and more like an insurance actuary. They aren't just checking if you have a job today. They are actively stress testing your ability to pay your mortgage if interest rates suddenly spike by 2%.
Exactly. They are very conservative. And alongside that rigorous underwriting, we are seeing their credit costs normalizing to 7 basis points in this quarter.
Okay, so provisions are going up slightly.
Right. During the immediate post-pandemic recovery, provision levels were scraping the bottom of the barrel, sometimes even resulting in write-backs.
Yeah, we covered that in the previous deep dive.
Right. So now they are preemptively setting aside a bit more money to cover potential bad loans. It's a normalization to a steady state, not a crisis.
And even if a crisis did hit, their loan loss coverage ratio is sitting at 149.9%.
Yeah.
Which means for every single dollar of a bad loan, they have $1.50 sitting in reserves.
And it gets even more robust than that.
Wait, really?
Yeah, if you factor in the regulatory reserves mandated by the central bank, that coverage ratio jumps to a massive 248.7%. Over $2 for every bad dollar. Plus, they are still holding on to over 800 million ringgit in unallocated management overlays.
Okay, so those are essentially preemptive rainy day funds set aside during the pandemic that they just haven't touched.
Right.
The inner keep of the fortress is packed with rations.
It is. They have built an immense buffer against systemic shocks.
Okay, before we figure out exactly how they fund this fortress, which is a fascinating strategy on its own, if you are getting value out of this financial deep dive and want to keep these professional stock analyses coming, please take a second to hit that like button and subscribe to the YouTube channel right now. We cover a lot of ground, and your support really helps us keep bringing you this level of independent research.
Yeah, definitely. So now, regarding how they fund this fortress, we really have to talk about their CASA ratio.
Okay, CASA.
Yeah, CASA stands for Current Account Savings Account. And as of the Q2 2026 report, their CASA deposit base is 127.83 billion ringgit.
Wow.
Which makes up 27.9% of their total deposits.
Okay, so 27.9% CASA is a solid shield against the NIM compression we talked about. Because CASA is essentially free or dirt cheap money.
Exactly.
It's like getting an interest-free loan from your depositors that you can then lend out to others at a profit. It's transactional money sitting in checking accounts earning near zero interest.
Right.
But here is the critical question. How do they keep that money sticky?
Right. Because of the deposit war.
Yeah. If I know I can get 3.5% in a fixed deposit somewhere else, why do 57.4% of public banks' total deposits still come from everyday retail individuals who just leave their money there?
Well, that is the highest retail proportion in the Malaysian banking sector, and it comes down to logistical and generational habit.
Okay.
Their physical branch network is so deeply entrenched in suburban commercial zones that local small and medium enterprises, the SMEs, and older retail customers use them out of pure convenience.
Ah, that makes sense.
Yeah, their payroll is there, their vendor payments flow through there. It is highly frictional to move your entire operational banking life just to chase a 0.5% yield.
Yeah, nobody wants to deal with that paperwork.
Exactly. So that money stays put. It provides a massive, stable funding foundation that just isn't highly sensitive to yield changes.
Sticky, low-cost money.
Where?
I love it. Okay, so we have the raw numbers. But financial metrics don't exist in a vacuum, right? They are driven by human decisions.
Right.
Let's connect this to what happened when management actually had to face the shareholders. Because on May 5, 2026, Public Bank held its 60th annual general meeting, followed by an extraordinary general meeting. And the Minority Shareholders Watch Group, the MSWG, they brought some heat.
They absolutely did. I mean, the Q&A sessions at these general meetings are where management is forced to publicly defend their strategy.
Yeah.
And 3 major themes emerged. And the first one was the looming threat of digital banks.
Right. The narrative that agile fintech startups are going to just eat traditional banking alive.
Right.
Shareholders bluntly asked how Public Bank plans to preserve its dominance. And I saw the board mention they're spending roughly 500 million ringgit annually on IT and cybersecurity.
They did.
But I have to push back on that. 500 million ringgit sounds like a big number. But digital giants like Grab or C Group burn through that kind of capital in their sleep.
Yeah, they do.
Is a 500 million IP budget really enough to fend off digital disruption?
Well, if it were purely a technology arms race, maybe not. But management's response actually bypassed the tech argument and pointed directly to their structural retail moats.
Okay, what are those?
They hold a 19% market share in SME lending, 20.1% in residential mortgages, and a staggering 33.1% in hire purchase, which is auto financing.
So 1 in 3 car loans in the country.
Correct. And you don't get a 35-year residential mortgage or finance a fleet of commercial trucks from a digital app just because the user interface is sleek. Digital banks are competing for microloans and unbanked retail deposits. Public Bank is deeply embedded in the heavy lifting sectors of the economy.
Yeah.
So rather than cutting their loan margins to compete on price with digital banks, who, are largely still operating at a loss, Public Bank is using that 500 million ringgit to fortify their existing ecosystem.
Okay, how so?
A great example is that they preemptively blocked 2.0 billion ringgit in fraudulent transfers in 2025.
Oh, wow. Okay, that makes sense. Their moat isn't having the flashiest app. It's having the most secure, deeply integrated ecosystem.
Exactly.
Okay, what was the second major showdown at the AGM?
Yeah.
Because I saw a really peculiar note about Hong Kong taxis.
Oh, yeah. This is a perfect example of how macroeconomics ripple into a balance sheet.
Yeah.
A shareholder pointed out that the gross impaired loans ratio specifically for the bank's Hong Kong operations had slipped. It rose from 2.3% in 2024 to 2.81% in 2025.
Which is glaring when their domestic GIL is sitting at 0.54%.
That's right.
Why does a Malaysian bank have exposure to Hong Kong taxi defaults?
So Public Bank has a subsidiary network in Hong Kong, and historically, taxi licenses there are incredibly valuable assets. They're often used as hard collateral for commercial loans.
Oh, like medallions.
Right, exactly. But the CEO, Tan Sri Alec, had to explain that intense competition from e-hailing apps completely crashed the secondary market value of those taxi licenses.
So the actual collateral backing the loans just suddenly vaporized in value.
Precisely. You compound that e-hailing disruption with a general slowdown in the Hong Kong commercial property sector, and it led to a one-off impairment on a large commercial borrower. Ouch. Yeah, however, management was able to confirm to the shareholders that the Hong Kong portfolio has now fully stabilized.
That is fascinating. You would never spot the Hong Kong e-hailing collateral crash just by glancing at a headline revenue number on Yahoo Finance.
No, you really have to dig in.
All right, what was the third big theme, particularly at the Extraordinary General Meeting?
Well, the EGM was laser focused on capital return, and management really delivered there. Shareholders overwhelmingly passed a 10% share buyback mandate, with 97.47% voting in favor.
A buyback mandate is always a powerful signal. I mean, it means management believes the stock is undervalued, and it gives them the flexibility to step into the market, reduce the outstanding share count, and artificially boost that earnings per share metric over time.
True, but the arguably bigger news was their commitment to what they call the 1% surplus plan.
Okay.
Under the ongoing Basel III capital reforms, banks are required to hold highly stringent capital reserves.
Right.
Public bank operates so conservatively that they currently hold about a 1.0% capital surplus above those strict regulatory minimums.
Oh, nice.
And management explicitly committed to distributing this surplus back to shareholders over the next 3 years.
That is music to a yield investor's ears. I mean, distributing excess capital rather than just hoarding it to pad the balance sheet shows a deep respect for shareholder returns.
It really does.
And speaking of which, the Q2 2026 report declared a 10.5 cent first interim dividend.
Yep.
For anyone tracking the timeline, that goes ex-dividend on September 10th, 2026, with the payout hitting accounts on September 23.
And when you combine the buyback mandate, the 3-year surplus distribution plan, and that 10.5 cent dividend, it paints a picture of a management team that is aggressively defending shareholder value, even when top-line earnings hit a temporary soft patch.
So let's pull all this evidence together.
Okay.
We have flat earnings growth due to a deposit price war, but it is defended by fortress-like operational efficiency, pristine asset quality, and highly pro-shareholder capital allocation.
Exactly.
How are we valuing Public Bank today with the current share price sitting at RM 5.155?
Well, for a mature, compounding banking institution, the absolute gold standard for valuation is the price-to-book, or PB ratio.
Right. And just to remind our listeners, we don't use price-to-free cash flow for banks because cash is literally a bank's inventory. The metric just breaks down mathematically.
Exactly. So we look at the balance sheet equity. Based on historical data, Public Bank's 5-year mean PB ratio is 1.574x.
Okay.
If we look at their latest Q2 2026 balance sheet, the book value per share, the BVPS, sits at RM 3.17 at the group level and RM 3.1 at the bank level.
Which means when we run those figures against the historical mean, we can establish our intrinsic value baseline.
Right.
And that leads us to the final verdict. Based on this exhaustive Q2 2026 data, we have updated our proprietary financial Moat scorecard for Public Bank bearer.
Roll, please.
The result is a 9 out of 10. We are maintaining its classification as a wide moat defensive giant.
Yeah, and the crucial takeaway here is why it retains the exact same 9 out of 10 score we gave it in our previous analysis of the Q3 and FY 2025 results.
But why didn't it drop?
The soft patch in earnings did not damage the structural moat. The bank still possesses unmatched cost efficiency with that sub-35% CIR. It still maintains a pristine loan book with the 0.54% GIL that shields its cash flow from default shocks. That operational discipline secures the 9 points.
But I know some investors are asking, well, why not a perfect 10? If it's such a fortress, why does it lose a point?
Because of the structural growth ceiling. Public Bank is so massive, holding dominant market shares like that 33% in domestic auto loans within a highly saturated, mature retail market.
Yeah.
There just isn't that much more domestic market share to easily capture without aggressively sacrificing margins or taking on toxic risk.
Right.
It is a stellar defensive yield play, but it is not and will not be a high-growth compounder.
It's the difference between investing in a high-growth tech startup and a utility company.
Yeah.
You buy the fortress for safety and steady dividend yield, not for explosive capital appreciation.
Exactly.
We've covered a massive amount of ground today. Let's distill this financial analysis down into 3 crisp, actionable takeaways based on this Q2 2026 report.
Okay, takeaway number 1. The soft patch is real, but the core is secure. We saw earnings hit a mild speed bump with only 2.0% growth in the first half, driven heavily by NIM compression and a normalization in credit costs. But gross loans still grew by a healthy 5.9% to reach 458.9 billion ringgit.
Yeah.
The fortress isn't crumbling, it's simply enduring a cyclical rate environment.
And takeaway number 2, their moat is operational, not technological. Don't look to Public Bank for explosive digital innovation that reinvents banking. Look to them because they can afford to lose a price war on deposits and still remain highly profitable, thanks to their 35-cent cost-to-income ratio and rigorous actuary-level risk control on bad loans.
Definitely. And takeaway number 3, the yield pays for your patience.
I like that.
Between the 10% share buyback mandate, the 3-year Basel III capital surplus distribution plan, and the recent 10.5-cent dividend, management is actively compensating shareholders to wait out the earnings sock patch.
So position your portfolio accordingly. If you need hypergrowth, look elsewhere. If you need an anchor, this is it. And that brings us to the end of today's deep dive. I want to give a sincere, warm thank you to you for tuning in and navigating this financial journey with us. If you found this analysis valuable, please remember to like the video, and most importantly, comment below with your thoughts. Are you holding public bank for the long haul, or are you rotating into higher growth sectors? Let us know down there, and hit subscribe to the channel so you don't miss our next stock analysis.
Yeah, we read all the comments, and it's always great to see how the community is positioning themselves.
Yeah, absolutely. To wrap things up, I want to leave you with a final provocative thought to mull over on your own. We talked today about how this bank is the ultimate domestic fortress. But as the global economy faces risks of renewed trade tariffs and increasing geopolitical fragmentation heading deeper into 2026, what happens to a defensive giant like Public Bank? Will its lack of high-growth overseas exposure be its biggest curse in a fragmented market? Or will staying safely within its insulated Malaysian fortress walls be its ultimate saving grace when the global storm hits? Something for you to think about. Thanks for watching, and we will see you on the next Deep Dive.